Hello and welcome to our discussion on the cash flow statement. In this session, we will see that the opening balance sheet is given, closing balance sheet is given, an income statement are given, the how to prepare the cash flow statement. So you can see the balance sheet given, an income statement, and cash flow statement is not there. It is possible to prepare the cash flow statement from the balance sheet and income statement because the change in the balance sheet can be explained by the income statement and the cash flow statement. So therefore, when the balance sheet and income statement is given, it is possible to find the missing number, and that missing number is the cash flow statement. So we'll start by determining the cash from operation. In other words, we are trying to use the accounting standard 3 format to determine the cash flow statement. So cash from operation can be determined as an adjusted profit. So profit is given as 23,800. We know that CFO is not same as PAT because or due to the following. Number one is the non-cash items. Number two is the non-operating items, and number three is a credit items. So cash from operation is not same as the profit after tax because of non-cash, because of non-operating, and because of the credit item. So we can make the adjustments for these items and derive the cash from operation when the PAT is given. So non-cash is a depreciation. So add back depreciation. Non-cash, which is shown in the income statement, is amortization of R&D. So add back amortization. Non-operating is interest is non-operating, and interest has been shown in the income statement, so we add back. So two of these items are non-cash and interest is a non-operating item. Then we'll see the changes in the working capital, which is also called the credit item. So the debtors in this period has actually increased. So that means we sold the goods on credit during this period. Increase in the stock. The stock is also a current asset. So increase in the stock is also a cash outflow. That means we purchased the goods during the period and have not used the stock in this period. Decrease in the creditor, that means we paid money to the creditor, so it's a cash outflow from the operating decisions. Increase in the outstanding expenses, that means we have not paid money to this extent in this period, so therefore outstanding expenses increase will be added. And you can see that outstanding, the expenses which is there 2,000, and that means the entire expense have not been paid during the period. So cash from operation is an adjusted profit adjusted for the non-cash, non-operating, and the changes in the working capital. So CFO is 28,500. Then we'll see CFF. The cash from financing will show the receipts from the financing decisions and the payments from the financing decision. In this case, the receipt from the financing decision is the change in the capital. That means we have issued the shares during this period, and that too, issue of shares has happened at a premium, and both are cash inflows. So cash inflow due to financing decision is 50,000, and cash outflow from the financing decision is interest, no other outflows. So the summation of inflows and outflows, 47,000, is a cash from financing decision. Now if you see, the investment decision is a purchase of assets or purchase of R&D, but the asset has changed only because of depreciation, so there is no outflow or inflow because of purchase. In other words, there is no sale or purchase of plant during this period. However, the R&D, there was no R&D in the beginning. There is an R&D of 40,000 and we amortize R&D of 20. So that means we have actually purchased the R&D to the extent of 40,000 to 60,000. So how did we get that 60,000? 60,000 is 0 minus 40, okay, minus 40 because there is no inflow, minus 40, and 20 is the amortization, so minus 60,000 is the cash outflow due to the purchase of R&D. Since there is no other payments or the receipts from the cash from investment, so the cash from investment decision is negative 60,000, is negative 60,000. So cash flow statement, if we summarize that, so opening cash in hand is 40,000, CFO during the period is plus 28,000, CFF of the period is plus 47,000, and CFI a negative 60,000. So if you sum this up, we'll get the closing cash in hand, which should be equal to 55,500. So cash flow statement has been prepared by seeing the interrelationship between the income statement, the balance sheet, and the cash flow statement. So whenever there is two balance sheets and the income statement is given, it is possible to prepare to determine the various cash flows. And the various cash flows are the CFO, CFI, and CFF. The CFO is an adjusted PAT, is adjusted for non-cash items, non-operating items, and the credit items. Thank you very much.